As long as farmland and its produce are valued primarily in financial terms, the corporate landlords will remain. Still, every empire carries its pressure points. With ownership so concentrated, any shock, climate events, trade disruptions, or falling commodity prices can ripple through the entire structure. When profit expectations clash with environmental limits, the cracks widen. Yet for now, these agribusiness giants stand as monuments to a simple formula. Control the land, control the output, control the profits. What's unfolding across the countryside isn't just corporate growth. It's the privatization of the food chain itself. Behind every grocery store shelf lies a network of contracts linking seeds to shareholders. The independence that once defined American farming has been replaced by efficiency managed from afar, where balance sheets dictate planting decisions miles from the fields they affect. And once the land, water, and crops are bound together under finance, speculation is the only frontier left. Farmland as a commodity. By the dawn of the 202s, farmland was no longer just a piece of earth. It was a ticker symbol. The same fields that once grew wheat and soybeans now underpin new financial products designed for investors who'd never set foot on a farm. For Wall Street, this was the next evolution. Farmland as a fully tradable commodity, an asset to be sliced, packaged, and sold. The transformation was subtle at first, presented as an opportunity for retail access to agricultural real estate. But underneath the polished language was the same mechanism that once turned mortgages into securities. The model started with farmland investment funds. Firms like Gladstone Land and Farmland Partners created publicly traded REITs that owned farmland across the country, renting it to operators and paying investors dividends from those rents. In earnings calls, executives spoke about portfolio composition and geographic diversification, not irrigation or soil quality. For investors, farmland became another line item on their asset allocation chart, a tool for balancing risk, not feeding people. A farmland REIT owns hundreds of parcels scattered across states: almond orchards in California, cornfields in Illinois, berry farms in Florida. Those parcels generate cash flow through leases. Shareholders earn income the way they would from office buildings or apartment complexes, except the tenants are farmers paying rent in seasons instead of months. The appeal was clear. From 1992 to 2023, privately held farmland averaged roughly 11% annual total returns, rivaling stocks and outperforming bonds. As this template proved profitable, new products emerged. Private funds, crowdfunding platforms, and fintech startups promised to democratize agriculture. Websites invited small investors to buy fractions of a farm for as little as $10,000. It sounded noble, helping people own a piece of America's soil. But what they actually bought were securities backed by farmland deeds. The structure mirrored fractional real estate ventures. Investors pooled capital, companies purchased land, revenues flowed through rental income and appreciation. Ownership, once physical, became digital. To seasoned financiers, this financialization made perfect sense. Farmland's key attributes, limited supply, stable production, and inflation correlation, fit perfectly into the modern portfolio theory playbook. Institutional presentations showcased farmland's low volatility and steady yields against benchmark indexes. Analysts at advisory firms even coined new phrases: agricultural alpha and soil-based stability. The earth had become an equation. But when numbers define value, speculation follows. The first wave of farmland securities performed well, attracting pension funds and insurance companies hungry for refuge from volatile equities. As demand surged, so did the price of the underlying land. In certain regions, farmland prices rose 40% in under 3 years, far faster than agricultural incomes. That discrepancy didn't deter investors, it encouraged them. Rising prices validated the thesis that farmland could only appreciate. It was self-fulfilling optimism, nearly identical to the logic that fueled the housing boom before 2008. Once securitization began, innovation accelerated. Firms experimented with farmland bonds and exchange-traded funds tracking indices of agricultural real estate. In one promotional video for a farmland ETF, a narrator framed farmland as the new oil: limited, essential, and global. The sales pitch wasn't about food, it was about scarcity. The fewer acres available, the greater the financial premium. Investors weren't buying farms, they were buying a story of permanence in a world of uncertainty. Inside conference halls, farmland investment summits grew popular. PowerPoint slides presented yield curves alongside photos of sunlit fields. Speakers compared soil values to gold reserves, emphasizing that both came from the ground and both hedged against inflation. In practice, the new asset class behaved like any speculative boom. Capital flooded in faster than the real economy could absorb. For example, consider a pension fund managing retirees' portfolios. It invests $100 million into a farmland partnership owning Midwestern cropland. The partnership packages its holdings into shares redeemable on secondary markets. An investor in London or Singapore can now trade exposure to American farmland without ever seeing it. Price becomes abstract, driven by perception and liquidity rather than crops or rainfall. A bad harvest doesn't significantly dent valuation because investors care more about long-term appreciation than seasonal yield. The farmland's productive reality no longer dictates its price. Financial sentiment does. This detachment spawned new feedback loops. Rising valuations allowed funds to borrow more against their portfolios, using farmland as collateral to buy yet more farmland. Each purchase pushed prices higher, justifying further leverage. The process echoed the pre-crisis housing market, where asset-backed securities multiplied faster than underlying value. Farmland wasn't at that scale, but the direction was eerily familiar. One agricultural economist from Iowa State described the shift bluntly. We stopped asking what the land can grow and started asking what it can borrow. The Farmland RIT model, while transparent on paper, encouraged debt layering because agricultural assets appeared so stable. When interest rates were low, that stability made borrowing almost risk-free. As rates rose in the mid-202s, some funds found themselves overextended, facing margin pressure not unlike mortgage lenders once did. Yet few investors noticed because the story of farmland's never-ending appreciation remained persuasive. In promotional materials, farmland fund managers used sleek infographics to sell the dream. A typical deck promised double-digit total returns, natural inflation protection, and tangible asset exposure. Nowhere did it mention that tenant farmers bore nearly all operational risk. If yields fell or drought slashed production, rents still had to be paid. Farmers carried the volatility, investors collected the stability. Wall Street didn't invent this imbalance, it refined it. Agricultural economies have always shifted power upward, from laborers to landowners. But now, those landowners were spreadsheets and conglomerates, not individuals. The securitization process anonymized accountability. When a tenant farmer defaulted, the foreclosure wasn't imposed by a person. It came from a system executing contracts. A Kansas wheat grower who missed a single payment due to drought found his lease terminated by an algorithm tracking performance efficiency. The land was released to a larger operator that promised higher yield benchmarks. Automation enforced hierarchy. As securities multiplied, regulators hesitated. Farmland markets had little precedent for large-scale financial products, and oversight agencies lacked jurisdiction. There were no equivalents to mortgage-backed security ratings or capital reserve requirements. Instead, farmland funds operated under real estate investment exemptions, allowing rapid expansion. Lawyers structured deals in ways that skirted banking rules, calling farmland assets agricultural infrastructure. It was a loophole wide enough for billions to flow through. Investors rationalized the influx as beneficial to rural economies. They argued that capital investment modernized agriculture, introducing technology and efficiency. And in some cases, they were right. New irrigation systems, renewable energy projects, and improved logistics took shape. But those upgrades served return metrics, not community resilience. When global commodity prices dipped, funds simply shifted strategy, selling properties or converting them for non-farm uses like solar leases or logistics hubs. The farmland became a flexible asset, its purpose changing with market cycles. By mid-decade, the boundary between farmland finance and general real estate dissolved completely. Major asset managers folded agricultural divisions into their broader property portfolios, analyzing farms alongside warehouses and data centers. Quarterly reports mentioned agribeta exposure next to urban logistics yield. The language erased any distinction between a wheat field and a parking lot. This blending of categories transformed perception. Media headlines celebrated farmland ETFs as sustainable investments benefiting from megatrends in global consumption. Sustainability became a branding tool. a way to attract climate-conscious capital while maintaining the same profit-driven structures. The pitch promised ethical dividends, make money while feeding the world. Yet behind the slogans was the same speculative cycle that had destabilized other markets. When investors profit from price movement more than productivity, volatility is only a matter of timing. On the ground, farmers saw it differently. Lease terms grew shorter, rents grew higher, and decisions about crop rotation or soil regeneration now required financial approval. A Nebraska farmer summed it up. "They treat my land like a bond. Bonds don't need rain." For Wall Street, farmland's beauty lay in its persistence. Crops might fail, but land endures. That durability made it ideal collateral. Funds bundled acreage into asset pools to back loans, just as mortgages had once supported debt instruments. Banks extended credit lines secured by farmland portfolios, betting prices would keep climbing. The system didn't yet show cracks, but old-timers recognized the pattern. In the 198's farm crisis, excess debt had wiped out thousands. History, it seemed, was patient enough to repeat itself. In analyst memos, one phrase appeared again and again. Farmland is the new oil. On the surface, they meant it as praise, describing an indispensable, finite commodity with global demand. But the comparison carried a darker parallel: boom, bust, and the environmental cost of extraction. The soil that had sustained generations was now another tradable unit of value, a means to hedge inflation and speculate on scarcity. The harvest wasn't grain anymore, it was return on equity. This phase of the story closes not with a crash, but with momentum. Farmland securities continued trading, funds kept expanding, and investors applauded quarterly gains. Yet beneath the charts and presentations, the same structural tension grew. Speculative capital built on the expectation that food-producing land would always rise in price. To understand how fragile that assumption is, all we need to do is look back at the last time an essential asset was treated as risk-free property on paper: the housing market before 2008. Because the next chapter in farmland's journey would replay that model with different consequences. The housing model replayed. The story of farmland's financialization might sound new, but its script is eerily familiar and dangerous. We've lived it before, in 2008, when houses stopped being homes and turned into speculative chips. Back then, the promise was safety. Wall Street said mortgages were solid because everyone needs a roof. Now the same mantra echoes with food. Everyone needs to eat, so farmland must be safe. But safety isn't value, and when money forgets that, collapse is never far behind. Let's rewind to that housing boom. Banks issued loans faster than regulations could keep up. Mortgages were bundled, sold, and leveraged into complex securities that investors didn't fully understand. The system ballooned, multiplied by speculation and blind optimism, until cracks appeared. When home prices dipped just a few percent, the entire financial architecture imploded. At the root of that collapse wasn't housing itself, but the separation between a basic human need and its financial abstraction. The same separation is happening now, acre by acre, across American farmland. After 2008, farmland was hailed as the anti-bubble. It hadn't crashed, it produced tangible goods, and its long-term returns looked steady. But within a few years, that story mutated. Investors who wanted predictable yield relied not on agricultural productivity, but on constant price appreciation. Their returns depended on farmland prices, continuing to rise regardless of what the land actually produced. When income falls behind valuation, just like mortgage payments once lagged loan values, the results aren't sustainable. A Wisconsin farm appraisal in 2023 made it plain. Land values had doubled since 2001, yet profits per acre barely moved. Yields hadn't grown and costs hadn't dropped. The only thing rising was speculative cash. Analysts started using a polite phrase, decoupled from fundamentals. What they meant was simple. Paper profits were replacing harvests. The financial engineering unfolded the same way it had with housing. Investment funds borrowed against existing farmland portfolios to finance new acquisitions. Banks offered credit lines secured by land whose valuations were based on other inflated sales. Each new purchase validated the next, reinforcing an illusion of ever-expanding wealth. Even small community lenders got pulled in, offering aggressive loans backed by collateral they assumed would never lose value. Sound familiar? It should. It's precisely how subprime lending began. confidence built on top of confidence, stacked like dominoes. At conferences, farmland fund managers pitched their products as agricultural mortgage-backed securities. The phrasing was meant to inspire confidence. But those portfolios behaved just like housing derivatives. They bundled unpredictable assets, diversified risk on paper, and magnified it in practice. If a drought or trade war erased farm revenues across a region, the ripple effect could hit every investor holding exposure to that land. Yet prospectuses continued to promise stable yield through appreciation. The resemblance to pre-crash mortgage advertising was uncanny. The human angle makes the comparison even sharper. In the mid-2000s, homeowners who missed mortgage payments faced foreclosure by distant lenders who'd never seen their neighborhoods. Today, tenant farmers who fall behind on rent face eviction from investors who've never seen their fields. The terms are different, but the power dynamic is identical. Those working the asset carry the risk. Those owning it collect the returns until the system falters. One agricultural economist in Illinois put it bluntly: "We've replaced subprime borrowers with over-leveraged farmers." Rising interest rates make that burden heavier. As central banks tighten policy to fight inflation, farmland funds relying on cheap credit find margins shrinking. Some respond by raising rents or cutting leases short to reprice higher. Others offload properties to new investors, passing the inflated asset to the next buyer. Just as mortgage originators once flipped risky loans before defaults showed up. Another parallel lies in narrative psychology. Before 2008, the phrase "real estate always goes up" justified almost any risk. Today its cousin, "they're not making more land," does the same for farmland. The slogan feels true, yet it hides the complexity underneath. Climate change reducing arable acreage, water shortages limiting productivity, and shrinking rural populations. But just like housing before its crash, facts don't matter when faith in perpetual appreciation drives demand. In both markets, detachment from use value becomes the quiet signal of danger. Houses stopped being places for families, they became balance sheet entries. Farms stopped being places of work, they become yield-optimized arbitrage. And as speculative capital floods in, new derivatives appear. Platforms have already introduced farmland-linked debt swaps and tokenized farm shares for digital trading. It's the securitization cycle repeating in real time, fueled by technology that lets money move faster than regulation. There's another echo too: moral hazard. Lenders and asset managers often bear little consequence if the system stumbles. They earn management fees on assets under management, not on long-term outcomes. During the housing boom, brokers said, "We'll sell the loan before it fails." In the farmland boom, managers say, "We'll sell the parcel before the market softens." When profit comes from movement rather than stability, collapse is a matter of timing, not possibility. Some attempt to deny the comparison. They argue the farmland market is less leveraged, therefore safer. And for now, that's partly true. Farms don't carry the same debt ratios as mortgages once did. But leverage isn't just official loans, it's exposure. Pension funds, private equity, and REIT shareholders are all financially dependent on continuous appreciation. If prices plateau, expected yields vanish. Even a modest dip could trigger widespread selling, because portfolios designed for endless growth tolerate no stillness. To see what that might look like, remember rural America in the 198s. Land prices collapsed after interest rates spiked. Thousands of farmers lost everything. The difference today is scale. Back then, local banks held most loans. Now global funds hold the deeds. A downturn wouldn't just devastate communities. It could ripple through pension portfolios and sovereign wealth funds worldwide. When farmland becomes financial collateral, the stakes expand beyond agriculture. The most uncomfortable truth is that the machine feeding this boom depends on scarcity and fear. Investors talk about food insecurity, climate risk, and inflation as reasons farmland is valuable.